Hey, what's up, guys? It's Arkham, and this title is called Why You Failed Trading ICT. And I'm gonna give you guys essentially three tips that I've personally used in my development as an ICT trader that I want to share with you guys that I think would, help you guys greatly here. These three tips I will go in depth into them, so don't worry. But I think these are the three biggest crucial tips that you can actually use right now to get better as an ICT trader and find consistency. But before we get into that, make sure you guys are following me on Instagram. Tons of breakdowns, tons of educational content. I'm telling you guys why I'm putting my stop loss here, why I'm entering the trade. I'm teaching you guys about dealing ranges, fair value gaps, all this. Would love if you guys support me on the Instagram. Much appreciated. But let's get into the first tip here. So the first tip I want to help you guys here with is awareness. And I gave a description here. Stop being so mechanical. Focus on narrative plus draw. Stop getting lost on the lower time frame. So ICT, you may know ICT as like fair value gaps and order blocks and all this stuff, but in reality, fair value gaps, order blocks, breaker blocks, those are simply just patterns. Those are patterns for how you get into a trade. A fair value gap is nothing more than a pattern on how you get into a trade. What a lot of new traders fail at is they'll see bullish fair value gaps or bearish fair value gaps and think, they should go long here or short here without understanding the context of the market. Before you come into the market, you want to be aware of the narrative. Where has price been? Where is it at? And where is it going? So, coming into the week here, we see that this weekly bullish fair value gap price comes down into it. That's a strong level of support, okay? Price is at a level of support here. We also took liquidity on the daily here. Another added confluence coming down to a 4 hour from Monday, Tuesday, Wednesday, now coming into Thursday. We have been seeing higher prices. Overall order flow has been going higher. So our narrative here is price is found support at this support level and structure has now shifted to the upside, meaning despite there being a bearish fair value gap right here, I can't look at that and be like, I want to go short here because the overall narrative and price is telling me higher prices. Why would I go short in this bearish fair value gap when overall structure and the higher time frame is telling me higher prices? And this is where a lot of ICT traders could get lost because they're not doing the proper top-down analysis. Not every bearish fair value gap will be respected and price will just go down. Not every bullish fair value gap will be respected and price will go up. You have to have the right narrative, you have to have the right context behind it, and this is why a lot of people say ICT don't work or he's this and he's that because this looks like a bearish fair value gap in sense, and ICT teaches bearish fair value gaps. When you see one, you want to go short, but you're not taking into account the context of the marketplace. We broke structure to the upside. Support has been found multiple times, multiple times. Why would I then go short here when overall structure on the marketplace has been going higher? And this is where the awareness comes into play. And I'm gonna give you guys a quick demonstration here. So we have two traders here. We have trader A and we have trader B. So trader A sees a bullish fair value gap here and he goes long. Trader B sees a bullish fair value gap here and he goes short. What ends up happening is Trader B ends up making money while Trader A gets stopped out. And the reason why is because Trader B is aware of the higher time frame structure compared to Trader A. Trader A simply just sees this as a bullish fair value gap. I'm gonna go long. Trader B understands that we just took out liquidity, plus price has been in a downtrend. This push higher was simply just a push higher to grab liquidity, and as we come down into this fair value gap, I'm not looking at that as bullish, but I'm simply looking at that as a inversion to where price can break lower, retest, and then continue its momentum lower. And that's what I mean by awareness. You have to be aware of the higher time frame and the overall market before you take trades based on fair value gaps and order blocks. And a lot of you guys get lost on the lower time frames because the lower time frames, there's a million fair value gaps, there's a million order blocks, there's tons of fair value gaps everywhere. But if you don't have the right context from the higher time frames, you're only going to be lost, which is why it's important before you come into the market, you have to do a top-down approach and a top-down analysis from the higher time frame trend and structure. And as you come into a market, use that higher time analysis to then form a bias. So when I came into the market here and I trade on the M5, I'm looking for longs. Yeah, there's a H4 fair value gap here, but looking at the daily, looking at the weekly, you know, I'm not going to be tripped out because of this because I understand that overall structure and overall bias is higher prices and overall draw on liquidity is higher. We have liquidity up here. Overall draw is higher. So let's fast forward here. Pulls down a bit. Boom. Rips right back higher. And then it just continues higher. You know? So that's what I mean by awareness. You have to be aware of the higher time frame, aware of the bias, aware of the narrative. Where is price at? Where has it been? And where is it going? And align yourself with the market and use the patterns like the fair value gaps and the order blocks as simply just entry techniques, ways to get into a trade as you're aligned with the bias. Number two is risk management. ICT talks about this all the time that the reason why a lot of strategies work and a lot of traders are profitable trading, just some of the most, random strategies like, RSI crossovers. It's not that, no shade to RSI crossovers, but it's not that that strategy is good, but that trader has proper money management skills. You can have the worst strategy in the world, but if you can manage your money effectively, it does not matter. You will be successful. You know, you will be successful, or consistent as a trader. I mean, I say successful, but you will find consistency. And these are kind of the five pillars, let's say, of risk management that I'm gonna go through each of them and you kind of decipher which one are you and how you want to trade. So, first we have the scalper, which scalpers are high win rate traders. They focus on primarily win rate and they aim anywhere for 1 to 1 to 1 to 2s. That's primarily the goal of scalpers, high win rates, 1 to 1s and 1 to 2s. So I'll see a lot of scalpers trade like this. So especially trend line traders and breakout traders. They'll trade something like this, and as price break this trend line right here, they'll take a trade right here, stop loss down here, 1-to-1, and then call it a day. This really depends on who you are as a trader. If you're someone who can identify the bias or the draw on liquidity, but you're poor in entry, this may be for you. If you knew the market was gonna go higher today, but you didn't know where to get in or your entry was poor, you may be a 1-to-1 trader where you're so confident that you're, willing to put a 10-point stop loss to make 10 points because you know it's going higher, compared to someone who isn't strong in the drawn liquidity and bias sector, but they have amazing entries. They can have something more like this, where they're aiming for 2-to-1s or 3-to-1s. So, but those are typically the two type of scalpers, but they'll typically aim for 1-to-1 or 1-to-2s, maximum 1-to-3s on their trades. Then you have the intraday traders. These are traders that scale out their position. So they'll take along here and then they'll start scaling out positions, taking profits off the table. ICT recommends this to basically all new traders to scale out of your positions. When you start to make money, you want to start scaling out of your position and secure those profits. And these are your intraday traders. This is very profitable, very, very, very nice. Then you have your swing traders. These are your full pool traders. So they'll get into a trade like this. They'll have a stop loss down here. They'll have a take profit like up here. And then they'll kind of just hold on to the trade until their target is met. This is kind of just a one and done approach. Most likely swing traders, they aim for 2-to-1s. 2-to-1s, maximum 3-to-1. So if you're just get in, get out type of trader, this would be you. Next, you have your Tom Hugards. These are your high stakes kind of traders. Um, this way of trading is very skillful. You have to be very disciplined in this way of trading. Essentially, a lot of traders, when it pulls back, a lot of traders, let's say you get in long right here, a lot of traders will actually take out their position here on the pullback. But Tom Hugard's approach and many other traders' approach that are very skillful, they look at this pullback as simply an opportunity to get back in. So Tom Hugard will actually scale in here on the pullback and he'll sell his full net position right here. Only scale ins, no scale outs. And sometimes he would scale in again aggressively. So this is very aggressive. If it does come back on you, it will hurt a lot more because you did scale in and you upped your trade from, let's say, initially risking 1% to now you're risking 1.5 to maybe 2%. So, but it is a way that skillful traders, if you do become very skillful as a trader, this is a way that, will be very, very beneficial to your overall risk management because you're making a lot more on your winners. You're scaling into your winners, meaning when you take a loss, it'll be a lot less than your wins. This is very high R multiple style of trading. And then you have your ICT style of trading. And this is how ICT actually, back in his 2016-2017 mentorship, actually ran up MT4 accounts. I think it was 10,000, 20,000 was the starting balance, and he would run those up to millions of dollars through this style of trading where he'd scale in again, scale out, scale back in, and scale out for his full position. Like this is how, this is the style of trading, scaling in and scaling out. It's very, very difficult to do this, and the reason why ICT can do this very effectively is because his strong suit is identifying low resistance versus high resistance liquidity runs in the markets, meaning to get this kind of move, you have to be in sort of a trend, because you can't trade like this during consolidation where it's doing this and this and this. You can't, you will blow your account doing this. So he's very good at understanding the trend, and when he's aligned with the market, he'll take full aggression with it. And this style of trading is very difficult, but it is the most profitable. But this takes, time to really develop as a trader. But the main focus of this risk management is understanding which style of trader are you in your money management. Are you a scalper where you're going for one to ones and one to twos? Are you an intraday trader? You're scaling out of your positions. Are you a swing trader? You just take a trade, aim for a one to two, one to three. That's it. I'm done. I'm done trading. Are you a Tom Hugar type of trader? You'll scale in every pullback. You'll scale in. Or are you a ICT trader where you'll scale in and scale out? That's the most skillful, which requires both high win rate and high R multiple. But as you develop and get better as a trader of it, there's so many ways to make money trading. It's not just aiming for one to two or one to three. There are people trading negative RR, making money with stop losses bigger than their wins. It's just identifying what type of trader are you. And the main focus is understanding that are you a high win rate trader or are you a high R multiple trader? You know, in utilizing that skill, I'm a high R multiple trader. I like to go for, one to threes, sometimes one to fours. So as a high R multiple trader, it's more probable for me to scale in on my winning positions and get more out of those. It makes more sense for you to kind of go for those one to ones and one to twos quick monies, or get that one to one secure profits and leave a runner. It makes sense for you to do that. So understanding where you are on the totem pole. And then third, last but not least, treating it like a business. And we're going to go over pre-market plan, rules, journaling, and back studying. Before you come into the markets, you have to create a plan that's based from the higher time frames. And it all starts from the weekly. Where are we on the weekly? Go down to the daily. Where are we on the daily? H4, H1, M15. And then you come down to the M5. The M5 and the M1 or whatever you trade is simply just an entry. This is simply just an entry time frame. Your context is derived from the higher time frames. It's like making your bed. You spend however much it takes, 10, 5-10 minutes to make your bed, but then once it's done, you kind of just lay on it and you go to sleep or whatever. Before you come into a market, you spend time forming a plan, forming a bias, and by the time you come down to the M5, you have everything made, you have everything set. I have my support and resistance areas. I have my bias. Okay, I'm bullish on the day. Boom, there's a level of resistance here. I want to see price break above this level of resistance. After breaking above it, I want to see it retest. And on that retest, if I can get a fair value gap or an order block or some type of entry, I will go long aligned with the market. That's all it is. That's all it is. Are you bullish or are you bearish on the day? And you formulate that bias from the higher time frames. So when you come down to the M5, you see this fair value gap. As price comes down into this fair value gap, you go long and you set your targeting however you set your targeting, and you implement risk management, meaning you could just be a 1 to 2 hour trader. As soon as it comes up here, that's it, you're done trading. Or you could scale in your positions. As soon as it comes up here, you add in and you see it showing respect, you scale in your position, move your stop loss up a bit. Or you could be a scale out trader. So as soon as it, comes up here, you scale out. Whatever works best for you as a trader. But me personally, I'm a scale in trader. So as price came down into this bullish fair value gap right here, my first entry is always the aggressive entry. So let's say I'll go in 3 contracts here at the open of this fair value gap. After price then shows support here and rejects it and goes higher, I'll scale in once more right here, and I'll put my stop loss below this low, and I'll keep my original take profit. And that's how I trade. You know what I mean? You could have a bigger stop loss, but aim for a 1 to 1. A lot of people trade like this, and a lot of people make money like this. No, it's whatever works for you, but the biggest thing is having that pre-market plan before coming into a market. Have a plan, have an idea of what you're looking for in price, and follow it. Follow that plan. Follow your plan. Next thing you know, rules. What are your rules? 1 to 2 trades a day, 1 to 3 trades a day. Create rules based on past pain points. Like me personally, I've had past instances where, in my earlier days as an ICT trader, I would overtrade. So I made it a rule to take 1 to 2 trades. Instead of focusing on quantity, I started focusing on quality. And that's what matters, you know, using those pain points and losing those losses as lessons. They're not losses, they're lessons to then create some type of rule or create some type of, I don't know, some type of system that can protect you in the future. You took that loss in the past, but you now created this system that tells you now, yo, like, this hurt me in the past. Let's not do it again. And these is where your rules come in. Next thing, journaling. Understanding where you're going wrong and understanding your metrics. Like, what is your win rate? What is your R multiple? Are you a high win rate trader? Are you a high R multiple trader? Or do you trade better during London session, or do you trade better during New York session? Understanding your metrics and keeping a journal of it. Understanding what are some of your best trades and what are some of your worst trades. Why did you lose that trade or why did you win that trade? It's very important. And journaling, keeping that backlog of data of yourself and your trading is what creates the rules. When I was taking those losses, I was journaling and realized, yo, I'm taking these losses because I'm over trading. Let's not do that. Let's put a rule in that. The reason why I trade the M5 instead of the M1 is because when I traded the M1, I was more susceptible to over trading. And I only learned that through journaling. And this is why so many traders can go months, if not years, without making any progress in their trading because they're not journaling. They're not keeping a backlog of where they're going wrong. They kind of just show up to the market every single day. You know, they're not treating it like a business. They just show up. You have to keep that backlog on yourself. And last but not least, back studying or back testing. After the market ends, look over it. Let's say I took a loss on this day. I tried to go short here. I try to go short here. Now the market's closed and the market's kind of finished. I can identify where I went wrong. Okay, I went short here because there was that H4 fair value gap right here. I remember I was talking to you about that. When instead I should have understood that the trend of the market was higher and I should have been looking for longs and understanding when Arkham told me that when order flow is bullish, bearish fair value gaps turn into inversions. So instead of going short here, I should have been looking at price to break above that bearish fair value gap, come back into it, and then go long and align myself with the market. Pre-market plan and back studying go hand in hand because it's data. Before the market opens, you're you're giving your assessment of what you expect to happen. And then when the market closes, you look over that, you look over your pre-market plan and you look over after the fact and you realize, okay, this is where I got it right, this is where I got it wrong, and this is where I can improve. And when you're journaling on top of that, you're understanding more in depth of where you're getting it wrong, where you're getting it right. And it's all data. You're picking up data to eventually you get to a point to where it's like you know what to do now. It's like trading is a bunch of puzzle pieces. You're picking a piece to a puzzle and you're one piece away from just, you know, being consistent. You're one puzzle piece away, one new rule or one journaling or one new something away from finding consistency. Creating a plan before the market opens, setting rules and following, abiding those rules as the market is trading, journaling after the fact, understanding where you went wrong, where you went right, and how you can get better, and then back studying, looking over the day, looking over your pre-market plan, understanding what you got right in the day. If you took a trade and you lost, how could you have improved that trade? What were you seeing in price at the time that now after the fact you're seeing that you could have been more aware, actually treating it like a business. Create a pre-market plan, create a set of rules, journal, backtest, and do that every single day consistently. It's all consistency. ICT tells you this all the time. You're not going to learn this. You're not going to improve at this. You're not going to master this in 1 week, a month, 2 months, 3, 4, 5, maybe 6 months. You get a gist of it in 6 months, but just consistently show up, consistently get better, and I promise you, like you will be better than most traders. Most traders aren't doing this. What if I told you that most traders woke up, flipped a coin, I'm bullish or I'm bearish on the day, came to the markets and traded? That's how most traders trade. That's why 90% of people lose. They're not taking this stuff serious. You start taking this serious, you start being consistent, and you start being disciplined to your trading plan, you will improve and you will get better. You will get better. But that's the video. I hope you guys enjoyed Arkham. I'm out.